When you're renovating a property, you're ripping out old cabinets, fixtures, appliances, and throwing them in the dumpster. But what a lot of investors don't realize is that all that junk you're tearing out is actually a hidden tax deduction. If you don't know me, my name is Ryan Bakey. I'm a CPA, and over the last 3 years, I've saved my clients more than $14 million in taxes. And this strategy, called partial asset disposition, is one of the most overlooked write-offs in real estate. This is a recorded coaching call I did for my friend Bill's mastermind, and on this call, we go over what a partial asset disposition study is, when and how to use it, and how to work with your CPA or cost seg provider to get this deduction right. So let's dive in.
One thing I want to talk about is, and I just filmed a podcast on this today actually, is people are skeptical that they'll get audited. People are skeptical that they're going to lose in an audit. And this was the case back in 2021, 2022. We've actually defended 5 short-term rental loophole audits for our clients. And we can say with certainty that if you do the right things when it comes to qualifying for the loophole, that you get your 7 days average stay, you hit your hours, that it is a tried and true strategy, and you shouldn't be afraid of an audit, because if you do it the right way, you'll win. The 2 big things here is that it doesn't matter what type of property you buy per se. Like, you can have a single family home, you can have a side-by-side duplex, you can have a hotel. It really comes down to how are you actually using it in terms of the occupancy. So are you renting it out with long-term leases, month by month or year by year leases? That's going to be considered a long-term rental. A short-term rental has an average of 7 days or less. Okay, so if you add up the total amount of days that the property is rented out for during a year, divide that by the number of unique bookings, that's going to get you your 7-day or less average. So in theory, and this happens a lot, we get clients that do this all the time. I even have properties in lake markets where I'll rent them out for a good 5 months out of the year, 5, 6 months. And then for 3 months, I'll make them into a midterm rental, and I'll do 30-day stays, 90-day stays. As long as your average is 7 days or less, you're good to go. So you can actually have a property be a short-term rental and a midterm rental, or like a hybrid, and still qualify. Okay, so that's a common question we get. And in terms of the hours requirement, it really isn't a lot, but you just have to make sure that you do it the right way. So you can either spend 100 hours, and this is combined between you and your spouse. If you're both working on the property, you can have 100 hours and more than any other person. So if I have a handyman, cleaner, contractor, I got to do at least 100 hours, and I have to spend more time than any other person. So there's a 100-hour test and there's a 500-hour test. Okay, the 500-hour test, I kind of call it the gold standard. It's normally going to be for people who have 2, 3, 4, 5 properties. Or if you had one property, you'd have to do a significant rehab in order to hit 500 hours in one property. Because if you do 500 hours divided by the entire year, it comes out to be about 10 hours a week, which is a lot for a single property, unless you're doing like a major rehab or renovation. So those are kind of the rules. Again, you should not be afraid or fearful of an audit, because we've defended this 5 times now. You should be excited to implement this as a strategy, because it's going to help a lot of you that are W-2 high earners who otherwise don't have a lot of write-offs or deductions outside of, say, a 401k, HSA at work, flexible spending account. You should utilize the short-term rental loophole to your advantage, but only once you determine that a property is going to cash flow. Because we do not buy real estate just for the tax benefits. We want to buy real estate that cash flows, that's in good markets, that's going to show strong appreciation, and the tax savings are just a cherry on top. We've seen deals go from an 18% cash on cash to a 32% cash on cash. I've seen deals go from 25% cash on cash to 52, 53% cash on cash in the first year by utilizing the short-term rental loophole. And this might be new to some, might be old to others, but what I'm about to show you next, I promise you've never heard before. Partial asset disposition. We don't have to say this. Try saying this 5 times fast real quick. Partial asset disposition. We're just going to call it PAD moving forward. Okay. Just like I dubbed the lazy man 1031 exchange instead of the poor man's 1031 exchange, we're going to call this strategy PAD moving forward. Okay. So a pad is where you replace something in a property with something that's new. Okay. So in this example, we're talking about a roof. You buy a house, the house has a roof on it, and you have to replace the roof completely. What do you do? Okay. Think of it like, so my wife just got a brand new car over the summer. Okay. And when you buy a new car, what do you have to do with the insurance company? Well, unless you want to pay insurance on two vehicles, on the old car that you had and the new car that you bought, when I trade in my vehicle for a new vehicle, I have to remove the old vehicle off my insurance policy. Otherwise, I'm going to be paying insurance on a vehicle that I don't have. So just like you would never pay insurance on a vehicle that you don't have, you also have to tell the IRS that you no longer have the rest of that roof. The roof is no longer there. I actually bought a new roof. I installed a new roof. Okay. And the IRS gives you a deduction for the value of whatever you replaced. So if I replaced an old roof, an old HVAC, an old plumbing system, if I replaced anything that's structural to the building, I get to write off that cost of whatever it is that I replaced, and I get to add the new value of whatever I spent to replace the roof. Okay. And it's a very nuanced topic, but I promise you that it can save an investor hundreds of thousands of dollars over the course of their investing career, especially the types of properties that we like to buy, where if we're going to make them luxury short-term rentals, we're going to have to replace a lot of stuff. Grandma's furniture, old buildings are not going to cut it. We have to replace it with new items, new furniture, new structure, new drywall, new carpet, new paint, new flooring, new everything, right? And so you get to write off the cost of everything that you replace by using this strategy. And most people, 99% of people are not using this strategy when they have a major renovation or rehab.
My property in Montana that we were talking about that you saw briefly, I've calculated it, and I want everybody to understand. Ryan, you just introduced this to the inner circle about 4 weeks ago, right? And then Ryan and I went, what was it, 2 weeks ago? I guess maybe 10 days ago, we went on the fly fishing trip. And that time period, over about a 2 week period, I've identified. And then I just had another one today. I just had my HVAC go out. I got to replace the entire unit, right? So I'm about $41,000 in pad savings before I even start the cost seg process because of this. And folks, I'm a pretty damn good investor, been around a while, and I didn't know about this either.
It's kind of just the low-hanging fruit. And the IRS isn't going to send you a letter or call you and say, hey, I know you did a big rehab over there and replaced a lot of stuff. We actually owe you more money. It's your job and responsibility to be educated about that and know that you have that deduction available to you. But pretty much whatever the cost of the items that you replace, you multiply that by your tax bracket, and that's what you stand to save in taxes. So if you bought a house that had a roof and that roof has value, let's say it's $10,000, but you have to replace that roof down the line. Well, that $10,000 multiplied by your 30% tax bracket, it saves you $3,000 by writing off the cost of the old roof on your tax return, and then multiply that by everything that you're replacing a property. And I would say it's like, I was doing some rough math the other day. I think for every about $100,000 that you do in renovations, it equals about $20,000 just in replacement savings, if that makes sense. If you spend $100K in rehab or renovations, you can expect to save about $20,000 just utilizing this replacement strategy. That doesn't even count the deductions that you get for adding the $100,000 on there, which that probably actually checks out, because you said you were going to say 40,000, right? And you've spent how much on the property to renovate?
To date, about 320,000. We're going to be 600 it's the biggest renovation we've ever done. We'll be at 600. So I hope it, escalates to 120. I have not underwritten everything yet. That was just like the flooring and paint, some of the basic stuff that we talked about. Like literally, I'm replacing $11,000 HVAC right now. Right. So, I mean, in reality, I guess that could be another $2,500 to $3,000. And we haven't even got into the garage/event center that you saw as well.
It's about 15% right now, give or take.
Yeah.
So probably 15 to 20% of whatever you put in renovations is what you can expect to save by doing the partial asset disposition, the PAD study. We'll call that
the PAD study. And this is what I want to make sure everybody understands. That's pre-cost seg, right?
Yeah.
So that's pre-cost seg. So if I can end up on a $600,000 renovation and get 75, 80,000 before I reach out to my cost seg guy and start that process, because and I'm going to show you guys what I already know what my estimate is from my cost seg guy for this property. That's a significant amount of savings.
Leon asked, what if you have 20 properties? How do you make the time commitment of 100 hours per property? So Leon, if you have 20 properties, you're likely going to group all the properties together using the 500-hour test. And in that example, you wouldn't have to necessarily keep track of each property. As long as you hit 500 hours across all of them, then you're good to go for purposes of those tests. And so that's also what we see with people who manage their own properties and also have property managers. So we have a client that has 12 or 13 properties. They have 5 or 6 of them that they like to manage themselves because they're local to their market and they're pretty big properties. And then they have another 6 or 7 properties that they have co-hosts or property managers for. Well, as long as you hit 500 hours in the properties that you manage, you're actually able to group all the ones that you own together. So now even the properties that are co-hosted or managed by somebody else, you can take the tax benefits from those as well.
And Ryan, I don't think anybody's asked a question. I'm sure somebody's thinking it. You do not have to be a real estate professional to qualify for a material participation for a cost seg study on an STR, correct?
That's correct. Yep.
Sophia, unfortunately, if you are in a 28-day minimum, you are not going to be able to qualify for the short-term rental loophole.
There is a midterm rental loophole, though. That's for another training.
We'll do that another day. That could get confusing.
In your example, you write off the cost of the old roof, yes, and then what do you do with the value of the new roof? So exactly, right? So if you don't write off the cost of the new roof, then in theory, you are now deducting 2 roofs on the same tax return, even though you don't own 2 roofs. So you have to remove the old roof off of your tax return and add the new roof on, and then the new roof that you add on, that depreciates over 39 years if it's a short-term rental property.
So the $10,000 would be the value of the old roof, right? And
Yeah.
then you would get your roughly 20% of that. So say $2,000 is depreciation. Then you put the new roof on, you bring in our cost seg guy, and then he's going to amortize that, over the life expectancy of the roof, which may be 10 years, probably really 20, but it could be 10 if you buy a shitty roof. As opposed to the standard of the 27.5 years.
Yeah, right. So partial pad is for any type of rentals. It could be long-term, short-term. You really want to make sure that whatever property you're doing it on, you qualify to take the losses from that property against your active income, which goes into what we're teaching you today. So you would want to time up, and it works. It actually makes a lot of sense because if you're doing a lot of renovations or rehabs, you're going to have enough hours to qualify to write that off against your W-2. So they kind of go hand in hand. You need to do the pad in order to get the loss. And then you also need to do the work in order to deduct the loss against your W-2. I think that makes sense.
Ryan, this is an interesting question. Do you see Matthew's question for vacation rental property managers in this group? How can we present the STR loophole as a benefit that lets owners terminate their current management contracts, self-manage for the remainder of the year to qualify, and then transition management to me on January 1st? So if we're in September right now, right? If somebody bought a property in February and then had a property manager February, March, April, May, June, July, August, and September for 8 months, can they fire their PM today and then self-manage for the rest of the year and still qualify for material participation? I think I know the answer, but I'm going to let you answer that.
Probably not, because they wouldn't, unless they were able to hit the 500 hours, but that would be unlikely because they would ask, like, what are you paying the property manager for in the first place if you spend 500 hours on the property? Well, what I would recommend if you're looking to do that is you're a property manager looking to see how somebody can qualify. So if that were me, I would have the client January 1st of 2025 start self-managing the property. Okay. And then as long as they have more hours than you in a given year, so have them manage it from January through August or September of next year. And then as long as they have at least 100 hours and it's more than you, then they would qualify for the material participation.
That last part that you said, because more than you, even if they got 120 hours, the property manager is still going to have put more hours over those first 8 months into management, right? And they paid them for that. So I think it's probably a gray area, But I mean, if you go through that audit, that auditor is probably not going to let that fly. Would you agree?
Well, especially because if you're going to want to write it off, you'd write it off under a management expense, and they're going to see the property management expense show up on your tax return.
Right.
So
So
that's also a red flag too. Like if you're claiming that you qualify for material participation, but you also have a property management expense on there, well, why did you pay them to manage it if you had to spend so much time? Says the IRS.
but the
I sound
flip
like a
side
children's
is
book.
for an investor like you and I, it's a great time to buy a new property and put it into service. Like if we went under contract today and we're closing in 30 to 45 days, so we're closing at, say, the end of October, we really only have to qualify for that material participation through the end of 2025, right? Then you could give that to a co-host or a property manager in 2026, correct?
Yeah, and there's nothing that prevents you from doing that. I would recommend try not to do that every single year and like get in the habit of that. Because then they might say, oh, this person bought a property November 15th and managed it for 45 days and then just flipped it over to a property manager or co-host and did that every year. Well, what was their original intent? You know, you want to go into it with a good story and a good reason why you flipped it to a property manager. Hey, I bought a property towards the end of the year. I thought I had enough time because of my job was kind of lowering their requirements, or I had more time, free time. I realized how hard it was to manage a property, so I decided to hire a property manager, and it just so happened to be after I qualified for this tax benefit over here.
Right. Ryan, somebody asked if is there anybody that is doing the pad for people, or is this all self done currently? Like there's not a pad specialist like we have for cost seg specialists, correct?
Some of the cost seg companies also do them, but very, very limited in scope. They're also going to probably want to do your cost segregation study. I mean, CPAs should be doing it for their clients. Obviously, it's the client's job to notify an accountant that they replaced stuff or they had to fix something, which whenever we see a bunch of renovations, you know, if we see renovations 25K plus on a property, you know, we ask, well, hey, what did you replace? Tell us what did you get rid of, right? Because you added 25K on. Were those just backyard amenities, or did you have to replace something and then spend 25K? So like we're trained to ask people that, but if you don't take it to an accountant, they're not going to know to do that for you.
We know the cost seg can't be done retroactively without an amendment of your tax return. Can a pad be done retroactively?
Yes, it can.
Yeah, Abby asked it. So then they would just have, they can do the pad if they purchase in 24 or 23, but then they would just have to go back and amend their tax return.
Amend that year. Somebody also asked, how are you valuing the item you're replacing? So that's a great question. So you can either use, like when you let's say when you bought a property, you did a cost segregation study on the property. It's going to break out everything that's inside of that property once you purchased it. And then a year or two later, you replace something. Well, it's very easy to identify the value of that item because you have it on the study. If you bought a house, but you didn't do a study on it and you're trying to figure out the value of the item that you're replacing, there are tools online that are indexed to the producer price index or the consumer price index. And so you kind of punch in like, okay, here's when I bought the property, here's the material, the shape and condition that the item was in when I removed it, and it'll do its best job to assign a value. There's tools out there online that can do that for you.
So Ryan, I'm getting a notification. We got time for one more question.
Okay.
Jason Wayne asked, does it just apply to the structure or can there be a landscape upgrade too? Like if you have to remove trees or sod or sprinklers to replace, would that qualify?
Yeah, that would qualify too. Yeah,
I just shot up over 100 grand, I think then.
well, the landscape normally is like a 15-year asset. So you're deducting that over 15 years. Well, if you own the property for 3 years and there's 12 years left, well, now you have to replace that. Well, now you're writing off 12 years of landscape that you should have been
Right.
deducting. Yeah, it's just think about the car insurance, okay? When you trade in your car for a new car, you have to tell your insurance company that you no longer have the old car. Otherwise, you're getting billed for insurance for two cars, even though you only drive one. Think about
Right.
that.
One last super quick question. I'm going to let you go, Ryan. This is from Aaron. Can you write off the designer's fee at the 3x in taxes, plus all the furniture, etc.? So I'm going to guess in a pad, you cannot write off a designer's fee.
Yeah, designers' fees are able to be deducted on your tax returns,
but not through the pad component, because you're just
not through
talking
the
about the assets.
correct. Yeah.
Awesome. Thank you for dropping some
You're
pad
welcome.
knowledge on us. I really appreciate it.
Just make sure we call it pad instead of the full term.
Partial asset distribution.
Disposition.
Disposition. See, it's hard. Do that after a glass of wine or a bourbon. That's not going to happen.